For the first time in history, Wall Street has been completely shut out of Canadian dollar bonds. That's right, not a single American bank participated in Ontario's $2 billion bond offering or Alberta's even larger $4 billion issue. The usual logos, Goldman Sachs, JP Morgan, Citigroup, were nowhere to be seen. Instead, the seats were filled by European and Canadian institutions, Barclays, RBC, CIBC, and Scotiabank. This isn't just a one-off event. It's a sign of something deeper, perhaps even a quiet shift in the global financial order. While cargo cranes continue to operate and the headlines remain focused elsewhere, warning lights are flashing on Bay Street. After decades of close financial ties, Canada seems to be slowly, but deliberately distancing itself from the U.S. As Canada's cabinet pushes for diversification into Asian markets, tariffs with Washington have become more than a trade dispute, affecting capital flows. The big question is, can global supply chains and financial systems adapt to this shift? Are we witnessing the slow unraveling of the dollar's dominance? Ontario's bond sale in early June sold out quickly. Pricing wasn't even an issue. But the absence of American banks at the table wasn't just unusual, it was symbolic. Quietly, without press releases or fanfare, a statement was made. Canada is ready to move forward, even if that means leaving its biggest financial partner behind. This isn't just posturing. In March, Alberta followed suit with a €4 billion euro-denominated bond, kicking Bank of America off the list. On the 27th floor of Calgary Plaza, risk managers stared out at the snowy mountains and bet that Europe would step in. And Europe did. Bond desks across Canada began reassessing risk. Swap desks adjusted collateral. Asset managers started hedging more aggressively between euro and dollar positions. On the personal level, the shift is just as real. In Edmonton, a pension fund manager canceled her regular trip to DC and instead had lunch with EU regulators in Frankfurt. In London, brokers barely blinked when Toronto asked to swap USD for GBP. This is the new normal, quiet, measured, and strategic. Meanwhile, in Ottawa, export strategies that had been gathering dust were suddenly being reactivated. Trade development agencies began mapping new routes to Southeast Asia. And at this year's logistics fair in Montreal, there was an unexpectedly strong Vietnamese presence, brokers looking to secure deals that didn't involve American banks or guarantees. Behind the scenes in Washington, the mood is tense. Canadian bond commissions had been a reliable but unflashy source of revenue for Wall Street. Their quiet disappearance doesn't make the headlines, but it shows up in the numbers. Senior executives at JP Morgan are reportedly frustrated after being excluded from new Canadian deals. One internal comment captured the concern. If you remove one small stone, does the wall start to shake? And it's not just about bonds. In late April, Ontario added a new clause to its procurement regulations. U.S. suppliers are only to be considered if there are no Canadian or allied options. Everything from steel components to IT services now has to pass through that filter. When a state hospital chose a bid from Stockholm over Seattle, it raised eyebrows, but the math backed the decision. Once currency and political risk were factored in, the European solution was just smarter. The Canadian dollar took an initial hit during the early days of the tariff war, but bounced back as Brent oil prices rose. Meanwhile, Canada's partial retreat from U.S. financial syndication began to influence the USD-CAD exchange rate. Traders noticed something subtle but important. It's getting harder to find U.S. dollars in the Canadian market after hours. That hasn't happened since the 1998 Asian crisis. For some Canadian businesses, the shift has created new opportunities. A solar panel company in Thunder Bay doubled its market share, thanks to tariffs on Chinese products. But the gains were fragile. When copper shipments from Shanghai were delayed by just 3 weeks, production came to a halt. Canada might be moving towards self-reliance, but it still depends heavily on global supply chains. Alberta is now actively seeking new oil routes toward Asia. Tankers are being rerouted, ports reevaluated. Financing is shifting away from American institutions toward European insurance consortia. It's a bold step, but not without risks. Green finance standards in Europe mean projects involving pipelines are now under extra scrutiny. And while President Trump is no longer in the White House, his legacy, especially around tariffs and economic nationalism, still casts a long shadow. Canadian analysts know better than to assume things will go back to normal. Diversification isn't just a goal anymore, it's a pillar of policy. Swap models in Toronto are now more likely to follow the European Central Bank than the U.S. Fed. Capital flows between Canada and the U.S. remain huge, nearly $1.5 trillion combined. But numbers don't tell the whole story. Policy moves slower than politics. And politics is becoming increasingly unpredictable. Even a small risk premium, just a few basis points, can reshape bond maturities and drive up insurance costs. One Montreal-based manufacturer recently put a planned factory in Ohio on hold, not because of tariffs, but because financing terms had become too uncertain. And on the same day, a Boston asset manager quietly opened a hedge position, preparing for the possibility of a 5-year trade war. Bay Street, once dominated by American influence, is now being quietly reshaped. The rain has turned to snow, and under the frozen ground, a new financial terrain is taking shape. From London to Frankfurt, Singapore to Tokyo, global institutions are leaving small but permanent fingerprints on Canada's future. As more nations re-evaluate their financial dependencies, Canada's pivot may be a bellwether rather than an outlier. Countries like Australia, South Korea, and even some EU members are watching closely. If the Canadian model proves resilient, balancing strategic autonomy with global integration, it could serve as a template for other mid-sized economies. But there are risks. A more fragmented financial system could lead to inefficiencies, duplicated infrastructures, and regulatory mismatches. Capital might flow less freely. Innovation could slow. And while detaching from the U.S. might reduce exposure to American volatility, it also means losing access to the deepest, most liquid capital markets in the world. Still, for many in Ottawa and Toronto, the calculation is worth it. In an age defined by shocks, pandemics, wars, climate disruptions, resilience is the new efficiency. Diversification isn't just about trade anymore. It's about survival. The old playbook is fading. A new financial choreography is emerging. And while its rhythm is still uncertain, one thing is clear. Canada isn't dancing to America's tune alone anymore. Some see this as strategic insurance. Others call it a symbolic break. Either way, Canada's dance with the U.S. is entering a new phase, and the music is getting louder. So what might happen next? If these trends continue, we could see a long-term structural shift. More bond issuances in euros and pounds. Canadian firms relying less on U.S. capital markets. A gradual, but very real, erosion of the dollar's supremacy in North America. And more countries watching Canada and maybe following suit. But here's the warning. Finance, like water, always find a path. If cracks form, it flows through them. But if the pipes freeze or worse, burst, the damage spreads fast. Canada is taking a calculated risk. The real question is whether it can maintain this new balance before the ice gets too thick. What do you think? Is this the beginning of a new North American financial map or just a temporary detour? Drop your thoughts in the comments. Make